As I'm making this video, the S&P 500 is down 23% off its peak, the 60/40 portfolio is having its worst year ever, and the 30-year mortgage rate is approaching 8%. 2022 is undoubtedly one of the worst years in history for markets. Plagued by various issues ranging from severe inflation to war in Europe, this wild situation has been escalating since January. But despite these crazy developments, we have yet to see a true meltdown moment, something like Lehman Brothers in 2008. But as I say this, various experts are now worried about exactly that, a Lehman-like event, a collapse in a major bank that ushers in complete panic and results in a financial meltdown. Everyone's eyes have turned to Europe, specifically to Credit Suisse, a massive bank in Switzerland that is drawing attention for all the wrong reasons. If the rumors are true, this bank is going under, and the consequences will be deadly. A contagion effect will take place, and the already damaged markets will receive the knockout punch. In today's video, we examine these rumors and attempt to dig through the details, calculating if this is our generation's Lehman moment or just another overreaction. We begin with a bit of history. You see, starting in October of 2007, the markets in the US began their gradual fall down. Nearly 10 months later, the market found itself down 20%. At this point, society was aware we were undergoing tough times financially, but no one realized that this was about to be the Great Financial Recession. An unprecedented era in America's history, plagued by job loss and bankruptcy. It was at this point on September 15th of 2008 that we saw this, the Lehman Brothers collapse. A bank that had existed since 1850 with over $639 billion in assets had seemingly collapsed overnight, bringing with it the entire American economy. It's easy to read about this event and judge it after the fact. How could anyone not see this coming? But the facts tell a different tale. On paper, Lehman was not that bad of a bank. Sure, they were undergoing tough times, but the health report wasn't exactly a death sentence. For example, in April of 2008, months before the collapse, a leverage analysis was completed comparing Lehman to all the other big banks, some of which survive to this day. It turns out Lehman wasn't actually that flawed in comparison. At the time, yes, leverage was increasing around the industry, and more banks were getting greedier and greedier, pushing risk beyond what is acceptable, but Lehman's net leverage had actually increased less than its peers. In fact, if we look at this table from the report which examines net leverage across the industry, you can see a surprising result. At the time, Lehman had essentially the same amount of leverage as Goldman Sachs and Morgan Stanley, two banks that ultimately survived the recession and went on to become well-known stable institutions. So what is it in particular about Lehman that made it collapse? Well, part of it is human psychology. It doesn't matter the facts. If you can get people to believe something is broken beyond repair, it will become a self-fulfilling prophecy. Right now, Credit Suisse is telling everyone they are well capitalized and not in danger. The same happened with Lehman right before the collapse, but ultimately the market and the information war is what will decide its fate. If panic ensues, it doesn't matter about the facts. This is exactly what Ottavio Marenzi, CEO of Optima, said on CNBC. His interview will leave you speechless, but before I show you his comments, please take a moment to hit that like and subscribe button if you're enjoying the content thus far. Now back to the clip.
Has a pretty good capital ratio, so they look pretty sound. They're in fact better than the average European bank, so that looks quite good. But bear in mind, a bank like Credit Suisse has to constantly go into the market raising money. They have to raise short-term money through short-term sales of bonds on an ongoing basis to finance their capabilities and their activities. And if they're not able to do that, even on a very short-term basis, even for a few days or weeks, they're going to be in very serious trouble. So there's nothing really that came out that Credit Suisse said, or any new news about Credit Suisse having some sort of new disaster. They did say that they're coming up with this major restructuring plan at the end of the month when they announced their Q3 earnings, and they were going to consider selling some assets. And that fairly vague statement is what set off the markets and said, oh no, Credit Suisse is hiding something. They've had very bad risk management in the past. If you look at their whole fiasco with that Archegos hedge fund where they lost over $5 billion because of very lax risk management, the market started to say there must be another skeleton in the closet that has now been exposed by the dislocation we're seeing in the market, and Credit Suisse isn't bad. But it was only really a rumor, nothing else. And so we've seen this tumble. But the real risk is that these rumors become self-fulfilling, and basically Credit Suisse then is not able to raise capital that in desperate needs, and basically you have sort of a run on the bank. So it looks a bit like a Lehman Brothers situation. Lehman Brothers, even going into its downfall, looked pretty sound on paper as well. Its capital ratios were quite decent at the time, and suddenly the bank was gone.
As you may already know, Credit Suisse came out weeks ago and essentially said that it's having issues with its business and will look to restructure in the near future in order to streamline its operations. This announcement set off a panic among investors who suspected the problems are much worse than what they're claiming. The stock price, which rose to a recent high in February, is down about 70%. But outside of this, a different graph tells the true story. You see, without making things too complex, there's something called a CDS. This financial instrument is basically an insurance policy against the default. Now, in the financial world, this insurance policy can be traded and therefore it has a price that goes up and down. The more risk or the higher the perceived chance of default, the more expensive the insurance policy becomes. In a way, you can figure out what companies are most likely to default by examining changes in the CDS price. If you're still confused, think about it this way. A house in Oklahoma will cost more to insure than the same exact house in Ohio because the perceived risk to the house is higher. Oklahoma has a severe weather problem that consistently damages houses. Ohio does not. So insurance premiums are high down there because the risk of default, or in this case house damage, is higher. Credit default swaps work in a similar manner. Back when Lehman was about to go under, the CDS price, or these insurance prices, rose from about 50 in early 2007 to nearly 400 in the months right before bankruptcy. These 5-year CDS graphs are an actual showcase of the perceived risk, and now Credit Suisse has the same exact problem. Earlier this year, its 5-year CDS was around 40. It jumped up to 100 in recent months before exploding to 259. At that price, the market is essentially saying that there is a 1 in 4 chance that Credit Suisse goes under. That's a big problem, and who's to say that people shouldn't be concerned? Even their CEO came out recently and publicly stated that the bank is in a critical moment. That's not exactly what you want to hear when your investors have suffered a 70% meltdown since February. And while we like to romanticize the Lehman collapse, it didn't happen overnight like the movies show. Lehman also suffered a slow decay before plummeting. At first, the bank announced cuts to its mortgage business, then it secured some debt, offered stock, it even got some help from the Federal Reserve. Actions that saw its stock price float sideways, then down for months. It wasn't until Q2 earnings in 2008 where the true panic set in. At that point, Lehman showed a large loss and investor confidence had plummeted. By September, the stock price had fallen off a cliff. From peak to bankruptcy, the entire process took 9 months. In the case of Credit Suisse, we are at the 10-month mark, with the stock price down nearly 70% just this year alone. Everyone's eyes will be on the next earnings report set to come out October 27th. Should there be anything to suggest more bad news ahead, the probability of bankruptcy will increase exponentially. And if one of Europe's largest players goes down, the impact will be severe, with a ripple effect that will surely be felt in American markets as well. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed it.